If you're new to the stock market, then you're at the right place, because in this video I'm going to show you how you can use stock market as a tool to increase your wealth and achieve financial freedom. And the way I'm going to explain is in 7 simple steps. First is why we need to buy stocks. Second is how to buy stocks. Third is how to make money through stock market. Fourth is why stock market go up and down. 5 is building strategy on how to invest in the stock market. Sixth is analyze and value the stock to make good financial decisions. And the 7th is what mistakes to avoid when going into the stock market. So the first question is, as a beginner, you always want to ask yourself why I need to invest in the stock market. And let me give you an answer. The number 1 reason is it's time tested. And number 2 is it has proven returns. So New York Stock Exchange, it has been around since 1792. And if you look at the last century, from 1925 till today, 2025, the stock market has returned over 10.49% every year. Now, if you go back and look at the past century, let's start from 1925. The Dow Jones were trading at 120 points. In 1955, it was trading at 422 points. In 1985, it was trading at 1,322 points. In 2015, it was trading at 17,500 points. In 2025, Dow Jones is trading at 42,000 points. So why to invest in the stock market? And the reason is stock market always goes up. Yes, there are some recessions, there are some corrections, there are some bear markets. When the stock market goes below 20%, there is a bear market territory. There are crashes. But if you look long term, more than 10 years, stock market always goes up. And the beliefs are that stock market will go up in the future. And yes, in the future, there will be some corrections. Stock market might drop by 30%, by 20%, by 10%. But if you look at the bigger picture, the stock market will dip a little bit and then it'll again rise. So over the long term, stock market always goes up. So there is a big opportunity if you're an investor in the stock market. Even if you're a beginner, you can own a piece of any stock. And if you're a beginner, you own a piece of any good company. In the future, it's predicted that you will make some good money if you're willing to hold that company or hold that stock for long term. So there is always opportunity in the stock market. And we cannot say that if the stock market is all-time high and there is no opportunity in the market. And we cannot say if the market is at down or it's at the all-time low, there is no opportunity, or that the stock market is going to dip and we don't need to invest, because dips always create opportunities. Many people become wealthy when these kinds of dip happens, and we will see in the video how we can take full advantage of these kinds of dip. Now, before we go to the second point, let's see what exactly stock market is. So let's say my company is Churn Cleaning Company. So I have 2 options, whether to go to the bank to borrow some money or go to the investor to raise money for my business. So the first option, I go to the bank and borrow some money. Maybe I don't want to go to the bank and borrow money. Maybe bank don't want to give me money. So I go to the investors. I tell them this is my company, this is the public company, and I raise money through the investors. And in return, I give them a piece of my company. So let's say the investors own 1% of my company and they give me capital to run. So that's how stock market works. Many big companies, they raise capital through their investors, like Coca-Cola. Warren Buffett has been investing in Coca-Cola for many years. And when you buy a share in the stock market, you become an owner of that company and you have some voting rights. So that's how stock market works. You as an investor invest in a stock market, and in the return, company give you a piece of profit or a piece of dividend, or you earn money through their appreciation. Now let's move to how to buy stock. So the first is company needs to be public. So the companies like IKEA, it's privately owned company, so you don't buy a share in IKEA. But the companies like Home Depot, McDonald's, they are publicly owned and you can always buy their stocks. So in the past, it used to be you have to call the company to buy their shares and it was a long process. But now you can just open a brokerage. So the 4 things that you need to make sure before opening a brokerage account. First is fees, second is reputation, third is location, and the 4th is type of account. You don't want to overpay the brokerage. I personally invest through Wealthsimple and it's the best one in Canada right now. I don't want to invest through TD or RBC and pay them transaction fees on every buying and selling. So I use Wealthsimple and there are many free apps. Second is reputation, how long the brokerage has been around. And the third is location. Is through that brokerage you can invest in any market, or you have to go to the other brokerage in other countries. And the 4th is type of account, whether you want to open a tax-free savings account, RRSP, or non-register. Will you able to open that account in this brokerage? And if you can apply all these 4 things, then that brokerage is good to go. So the company needs to be public and you need a brokerage to invest in a stock market. And now we know why to buy stocks and how to invest in a stock market. So let's jump into the third point, how to make money in the stock market. And there are 2 ways to make money in the stock market. First is through appreciation and the second is through dividend. So let's say you bought a stock of Apple for $150 and after 5 years, the Apple stock is trading at $250. So you bought 10 shares at $150. Now, the Apple stock appreciated by $100 in 5 years. So you own 10 stocks. So that's 10 multiplied by 100. So you made $1,000. And if you own more shares of Apple, you would have made more dollars. So the first is appreciation. When the stock rises, you make money. And the second is dividend. Like Warren Buffett, he's been investing in Coca-Cola from many years and he's mainly making money from dividend, and in a year he makes millions of dollars through Coca-Cola dividend. So the first, you make money through appreciation, second is through dividend, and you always make money through appreciation and their dividend as well. Like many companies, Apple, Coca-Cola, and the companies that pay dividend, they appreciate and they give you dividend as well. So stock market always have been a great way to build wealth and achieve financial freedom. Now let's move to the fourth point of why stock prices goes up and down. So it all comes down to supply and demand in the stock market. So let's take a sneaker. Let's take a pair of shoes. So there are so many pairs of shoes and there are not too many buyers to buy the shoes. So what will happen? There's an increase in the supply, but there are not enough buyers to buy them. So the price will drop so that people can buy. And the same is demand. And the demand is when people want to buy something and there is not enough supply, so the price increases. So let's understand with the example. So in 2020, Elon Musk announced that his plan for huge growth and huge profits. And investors rushes to buy Tesla stock. And the stock rises from $270 per share to $700, and that's before the split. So there was a huge growth plans and people rushed to buy the Tesla stock. So there was a huge demand. And in 2022, Mark Zuckerberg in Meta announced that they had a huge loss in Metaverse. So people rushed to sell their stocks and the Meta stocks fall to $72. So there was a huge supply there. So this is a practical example. All depends on supply and demand in the stock market. But the thing to consider here is that stock prices not always move by the profits, by the loss. It always moves on a people emotions and sentiment. It all depends on how people react to the certain news and what they're doing. Are they selling or they're buying more? And that's what drives the price of the stock. Now let's move to the strategy. What strategy we need to adopt to invest in the stock market? So there are basically two strategies. First is active investing and the second is passive investing. So let's talk about passive investing. If you want to invest in the stock market, when you invest in the stock market and you don't worry about what market is doing and you're just investing passively, that's called passive investing. And what active investing is that you analyze the stock, you listen to the news, what is going on in the world, what can drive the stock prices go up, what can drive the prices go down. So you're pretty active in the stock market. Look at the PE ratio, look at the fundamentals, you look at the charts, and you're an active investor. So what passive investor, they usually invest in funds like S&P 500, SCHD, and we're going to talk about in a further video. So they invest in funds that they don't need to worry about. And S&P 500 in the past 100 years have gone up by 10% per year. And 90% of the investors, especially the beginner ones, they are better off just investing in S&P 500 or SCHD. And active investor, they analyze the stock, they look for the news, they see what the economy is doing and invest accordingly. And you can always be both active and passive investor. But as a beginner, the more you're on a passive side, the better you will be. As you make more money in the stock market, you can always move to active, but always start with the passive. That's what I did. Now let's move to the sixth point, analyze the stock. So I use a very simple strategy to analyze the stock. First is, what does company do? Let's say Apple sell iPhones and we need to ask ourselves, does people love their product? Let's say Tesla, they sell electric cars. So what does company do is the first point. Second is we need to check the fundamentals or check the money. Is company making profit or are they going in a loss? And trust me, you don't want to invest in a company that is continuously in a loss. And then the third thing you need to check is debt versus the cash. Is company own more cash than what they owe? And the fourth is future potential. Is company is growing? Let's say the AI, artificial intelligence, we know it's the future. Or the industry is shrinking. Let's say the newspapers, DVDs. So we need to check the industry. Is the company in that industry is growing or is shrinking? And we need to check the PE ratio. Is the company has higher PE ratio or the lower PE ratio? Let's say right now, Palantir. And right now, I'm not investing in Palantir because it has higher PE ratio. And sometimes PE ratio is good. It's good for the growth. But some companies are overvalued and it has huge PE ratio. And that's when I stop investing in those companies. I usually go for the company that has good reputation, making good profits, have huge amount of cash and low PE ratio. And number 7, mistakes to avoid in the stock market, especially as a beginner. So the stock market always goes up and always goes down. We have seen many recessions, we have seen many corrections. But what many new investors do is that they invest in the stock market and when they see their stock is going down, they get panic and they start selling their stock and then they end up losing their money and end up not investing in the stock market. So that's what I want you to understand as a beginner. Stock market can go down. It's not a hard and fast rule that stock market will always goes up. Yes, in a long term, stock market will go up, but in a short term, let's say 1 to 2 or even 3 years, stock market might fluctuate. It might go down for continuously 1 to 2 years, but that creates opportunity to invest in the companies that you like, that has strong fundamentals and have good profits in the future. And if you're a passive investor like me, I always invest whatever the market is doing, whether it's going down, whether it's going up. When I started, every week I used to invest $200. Doesn't matter if the market is at all-time high or doesn't matter the market is at all-time low. So the simple thing is ABB. Always be buying when you're a beginner in a good index funds like S&P 500, SCHT, QQQ. I will make a video on how to invest in those ETF. But beginner investors, they make some mistakes when they come to the stock market. Sometimes they just invest one time and then expect that they will earn huge profits in the future. But the thing is that they forget to invest continuously. So I always say that when you invest in the stock market, every month you need to be consistent. You can't be investing just once and then expect that you will have good returns. If you're investing $500 a month, make sure that you're investing around that amount the next month as well. And the good way to go is to do weekly investment. Let's say $125, and it doesn't hurt. If you like this video, please give this video a thumbs up and subscribe to my YouTube channel. I'll see you in the next one.